Ready to dive into the world of quality investing? You've given us a stack of intriguing readings about finding companies with staying power, and we're excited to share the most fascinating insights with you.
It's like unearthing those hidden gems in the stock market, the ones built to last.
Exactly. And today's deep dive focuses on Lawrence Cunningham's book, Quality Investing. He blends financial theory with real-world company case studies, and we're going to explore what makes these quality companies tick.
We'll uncover the patterns that set them apart, their secret sauce for success.
So you want to find companies that are built to last, right? Well, Cunningham argues it all starts with how they allocate their capital.
He emphasizes that quality companies are incredibly strategic with their money. They invest in areas like organic growth, acquisitions, research and development, and of course, rewarding shareholders.
It's about finding that delicate balance, and he gives some great examples like L'Oreal.
They've consistently grown by carefully balancing spending across R&D, marketing, smart acquisitions, and dividends. It's like they found the perfect recipe.
Like they've cracked the code. Another example he highlights is Assa Abloy, a global leader in door opening solutions.
Yeah, since 2006, they've made over 120 acquisitions. They've boosted their revenue by an average of 8% each year. It shows how powerful strategic acquisitions can be.
Speaking of growth, Cunningham highlights the importance of a company's return on capital and how stable that return is over time. As investors, this is one of the most important metrics, right?
Oh, absolutely. It tells us how well they use our money to generate profits. And he makes a key distinction between maintenance CapEx and growth CapEx.
Maintenance is just keeping the lights on, right?
Yeah, exactly. Growth CapEx is about investing in expansion and innovation. Quality companies are very deliberate about prioritizing growth investments for the long haul.
It's the difference between maintaining your car and investing in upgrades. It's not just about keeping up, it's about getting ahead.
Exactly. And another thing, he argues that investments in R&D and advertising are often misunderstood.
They often get lumped in with expenses.
Right. But he makes a compelling argument that they're actually crucial investments for future success.
Long-term thinking.
Exactly. Take Unilever and their Dove soap, for instance. Their continuous marketing isn't just about selling soap today. It's about building a brand that resonates with consumers for years to come.
It's playing the long game. Now, acquisitions can be risky, but Cunningham does provide examples of companies using them strategically to consolidate their industries.
Essilor, the global leader in eyeglass lenses, is a perfect example. They've systematically acquired over 200 local optical labs.
Wow.
It gives them greater control over their supply chain and steadily increases their market share. It's like building a global network piece by piece.
And of course, quality companies share the wealth with their investors. Consistent dividend and buyback policies are key, right?
Absolutely. Excess cash should be distributed.
Yeah.
But Cunningham also cautions against companies going overboard with buybacks during booms and then holding back when times are tough.
It's about making smart, consistent decisions in the long-term interest of shareholders. Now, working capital. It might sound technical, but it's important.
Think of it as a company's financial breathing room. It's the difference between their current assets and their current liabilities. The more working capital, the more they can invest and grow without relying on borrowing.
So it gives them flexibility and independence.
Exactly. And some companies, like software and insurance companies, operate with negative working capital. They receive payments up front. It's a built-in cushion.
Interesting. And then we have profit margins, which are pretty intuitive.
High and stable profit margins are a strong indicator of a competitive advantage. It means a company can command premium prices without being squeezed by rising costs.
The classic example is Coca-Cola and Pepsi, right?
Exactly. Their production costs are probably similar to generic brands, but they can charge more because of their brand power and the perceived value they've created.
It's the power of the brand. Finally, quality companies don't rely on just one avenue for growth, do they?
No, they cultivate multiple sources of growth to ensure their long-term success. They don't put all their eggs in one basket. If one area slows down, they have others to keep them moving forward.
That's diversification.
Exactly. Syngenta, a leader in agribusiness, is a great example. They've succeeded through continuous innovation, creating new agricultural products, and expanding into new markets. They're always evolving.
Now, we can't talk about quality companies without discussing the management. Cunningham dedicates a whole section to good management.
While he acknowledges that great management doesn't guarantee success, he argues that certain characteristics are strong indicators of a company's long-term potential.
It's about the people at the helm.
Right. He emphasizes their role as stewards of capital. They need to make wise decisions about allocating resources, always keeping the long-term interests of shareholders in mind.
Absolutely. It's your money they are managing.
Exactly. And he highlights independence and tenacity. Quality companies often exhibit independent thinking and persist in executing long-term strategies.
Even when facing pressure to conform to short-term market trends.
Exactly. Look at Handelsbanken, the Swedish bank. They have a decentralized structure and a risk-averse culture. They've defied conventional banking wisdom and proven resilient during crises.
It's about having the courage of your convictions.
Right. Great managers also know that investing in their people is crucial. They prioritize developing and retaining talent, creating a culture of growth and innovation.
It's not just numbers, it's about building a strong team.
Absolutely. Atlas Copco, a global leader in industrial equipment, rotates executives every 3 years, exposing them to multiple aspects of the business.
That's a great way to develop well-rounded leaders. Now, you can't evaluate a company in isolation. You have to consider the landscape. Cunningham calls this industry structure.
He starts with monopoly power. And no, he's not talking about board games. He's referring to companies that have carved out a niche, giving them significant pricing power and higher profitability. He calls them mini-monopolies or partial monopolies.
So not complete domination, but a strong position in a specific market.
Precisely. L'Oreal, for example, leverages consumer perceptions in the beauty market to command premium prices.
They've built a brand people associate with quality and prestige.
Exactly. Then there's Ambev, the dominant player in the Brazilian beer market. Their massive market share contributes to their impressive profit margins.
A real stronghold. Cunningham also discusses oligopolies, industries dominated by a small number of players.
Yes, and he points out that while these can be very profitable, the dynamics vary widely depending on the competition and the customer base.
Right.
He contrasts the successful duopoly of Coca-Cola and Pepsi with the intense rivalry between Airbus and Boeing. It highlights how the nature of competition can impact profitability.
One's a friendly tennis match, the other's gladiatorial combat.
Exactly. And he dives into rationality mechanisms, unwritten rules that prevent companies from just slashing prices and destroying profits.
Like a truce?
You could say that. It benefits both the companies and investors.
So it's about understanding those factors that promote stability and predictability.
Right. And that brings us to customer benefits. Cunningham argues that quality companies go beyond just selling products or services. They provide tangible and intangible benefits that create lasting value.
Building relationships.
Exactly. He starts with intangible benefits like brand image and emotional connections. These drive customer loyalty and allow companies to command those premium prices.
Like Apple, people buy into their ecosystem and the lifestyle it represents.
Perfect example. Then there are assurance benefits, all about reputation for quality and reliability. Companies like SGS and Intertek offer assurance that products meet certain safety standards.
And people are willing to pay a premium for that peace of mind.
Absolutely. And finally, convenience benefits. Factors like accessibility, customer intimacy, and ease of use. Companies that make it easy to do business with them often have a significant advantage.
Like Amazon with their one-click ordering and fast shipping.
Precisely. So you see, there's much more to consider when evaluating a quality company than just their financials. It's about understanding those deeper elements that contribute to their success and protect them from competition.
It's about seeing the whole picture, their financials, management, industry, and customers. All these pieces fit together to create a sustainable, successful business.
Exactly. And in the next part, we'll delve into the patterns that often emerge in these quality companies, providing valuable clues about how they achieve those attractive economic targets.
Sounds good. Let's uncover those patterns.
He identifies a dozen patterns, and the one that jumps out is this idea of recurring revenue. Stable, predictable revenue streams from repeat customers. It's often subscriptions, service contracts, or just repeat purchases. Think KO&A, their elevators are basically a guaranteed income stream. That's stability.
Yeah, makes sense. It's like a built-in customer base. You're not always hunting for new clients.
Right. And speaking of cultivating a loyal customer base, there's this other interesting pattern he calls friendly middlemen. These are the intermediaries, distributors, retailers, or professionals who recommend products. They act as advocates, influencing choices and driving sales.
It's not just marketing to the customer directly. It's about winning over the people who influence them.
Exactly. Take Geberit, a European leader in lavatory products. They've built strong relationships with plumbers through free training programs. Their products are top of mind when those plumbers recommend stuff to customers.
So it's about being the go-to choice for the people advising the end customer. Smart.
Now, there's another pattern, the toll road. These are companies that provide essential, niche products or services to larger industries. They might only represent a small part of their customers' costs, but their offerings are critical, giving them pricing power and stable demand.
I like that analogy. It's like owning a bridge everyone has to cross.
Exactly. A great example is Crush Hansen, a leader in natural ingredients for food and beverages. Their ingredients are essential, and they dominate their niche.
They've got that must-have factor.
Right. Now, this one might seem counterintuitive at first, but it's called low price plus. Just undercutting competitors on price isn't usually sustainable, but companies that combine low prices with extra features or efficiencies, they can create a strong advantage.
So it's not about being the absolute cheapest. It's value at a price that's hard to beat.
Exactly. He uses Ryanair, the European low-cost airline, as an example. They're all about cost-cutting and efficiency, allowing them to offer consistently low fares while staying profitable.
I've flown Ryanair. No frills, but it gets the job done.
And then there's the classic pricing power, the ability to raise prices without losing customers. It's often a sign of a strong brand, a unique product, or a dominant position.
Yeah, they can pass on cost increases without losing business.
Exactly. Hermes, the luxury goods company, is the epitome of pricing power. They have strict control over their brand and distribution, they charge a premium, and people still line up.
They've created that aura of exclusivity.
And that ties in with brand strength, another key pattern. Strong brands built on differentiation, trust, and consistency. Think of iconic brands like Diageo with their world-renowned spirits.
Their reputation for quality spans decades.
Absolutely. He also highlights the pattern of innovation dominance. When a company consistently leads in innovation, creating a stream of new products or features to stay ahead.
Constantly pushing boundaries.
Exactly. Companies like Novo Nordisk, a global leader in diabetes care, have built their success on R&D-led innovation. They're investing heavily in groundbreaking treatments.
Investing in the future.
Right. Another pattern is forward integration. Companies that control their distribution channels, often through their own stores or franchising.
Cutting out the middleman.
Exactly. Luxottica, the eyewear giant, is a prime example. They've integrated into retail with acquisitions like Sunglass Hut, giving them greater control and a wide distribution network.
They own the customer experience.
And finally, market share gainers.
Yeah.
Companies that consistently gain share, even in mature industries.
Even in slow-growing markets, they expand their slice of the pie.
Exactly. Fielmann, a German optical retailer, has disrupted their industry with a low-cost, high-volume model. They consistently gain share and deliver strong returns.
It's about doing things right and having a competitive advantage.
Right. So we've covered a lot looking at these patterns of quality companies. But no company is perfect, right? There are always pitfalls to be aware of.
Red flags. What should we be watching for?
Well, he starts by discussing cyclicality. Many quality companies are in cyclical industries, but he warns against those overly dependent on things they can't control, like commodity prices or economic swings.
So be wary of those industries known for booms and busts. You don't want to get caught up in the hype and then crushed when the inevitable downturn hits.
Right. He uses Saipem, an Italian oilfield services company, as an example. They seemed strong during high oil prices, but when the market turned, they got hit hard. It shows the risk of being overexposed to volatile industries.
A reminder that even successful companies are vulnerable to external forces.
Absolutely. He also cautions against the allure of technological innovation, especially in fast-paced sectors. While innovation drives growth, it can also be incredibly disruptive.
So like the Nokias of the world that failed to adapt to new tech and got left behind?
Exactly. Their inability to adapt to smartphones led to their decline, showing how even the most successful can be vulnerable to shifts in technology.
It's sobering. No company is invincible.
Right. And even in slower-paced industries, companies can struggle if they get complacent and don't invest in R&D.
It's about staying ahead of the curve and constantly evolving.
Absolutely. Another potential pitfall is dependency. When a company relies too heavily on a small number of customers, suppliers, or stakeholders.
Like having all their eggs in one basket.
Precisely. He uses the example of global distribution systems in the airline industry. They act as intermediaries between airlines and travel agents.
Okay.
They've gained considerable power over time and can extract significant fees from airlines, impacting profitability.
It's a reminder to consider the power dynamics in an industry and how they might change.
Right. And lastly, he talks about shifting customer preferences. This can be a huge challenge as consumer tastes are always evolving.
Especially in fashion or technology where trends change quickly.
Exactly. If companies don't adapt, they can lose market share and struggle to stay relevant. He uses Nobel Biocare, the dental implant company, as an example.
Okay.
They faced pressure from cheaper competitors as dentists started using good enough alternatives.
It shows that even strong brands are vulnerable to market shifts. What's premium today might be overpriced tomorrow.
Absolutely. So we've looked at the potential pitfalls that can derail even the most promising companies. Now let's look at the last chapter, where he discusses how to actually implement a quality investing strategy.
Okay, so we've got the building blocks, the patterns, the pitfalls. Now, how do we put it all together and make it work?
He starts by addressing the challenges of short-termism, something we all face in today's world. With all the news, market fluctuations, and pressure for quick returns, it's hard to maintain a long-term perspective.
It's easy to get lost in the day-to-day noise.
Exactly. But Cunningham stresses that quality investing is about the long view, focusing on companies that are building sustainable businesses, generating strong returns, and positioned to thrive over time.
Tuning out the noise and focusing on the fundamentals.
Right. He encourages investors to resist chasing short-term gains and build a portfolio of high-quality companies that will compound their wealth over time.
So patience. Let those investments work for you.
He also acknowledges that this requires patience and discipline. Quality companies don't always outperform in the short term. There will be periods of underperformance.
There will be ups and downs, but it's about writing those out and staying focused on the long term.
Right. He also highlights qualitative judgments when evaluating companies.
So it's not just numbers, it's about understanding things that can't be easily quantified, like management and culture.
Exactly. Financial data is key, but consider qualitative factors too, like the management team's experience and integrity, company culture, and the sustainability of their competitive advantage.
It's about getting a feel for the company as a whole, not just a spreadsheet.
Right. Cunningham also discusses the risks of debt. While debt can fuel growth, too much can cripple a company, especially during downturns. He uses Tesco, the British supermarket chain, as an example.
Yeah.
They aggressively expanded into foreign markets using a lot of debt. It backfired, showing the dangers of excessive leverage.
Growth at all costs can backfire.
Exactly. Carefully evaluate a company's debt levels, their ability to handle it, and the potential impact on their stability.
Find companies with a healthy balance sheet and a responsible approach to debt.
Right. Then he talks about mistakes of retention. Even good investors make mistakes, but you have to catch them early and minimize losses.
We all make mistakes. The key is to learn from them.
Exactly. He points out common warning signs like profit warnings, accounting irregularities, and declining returns on capital. They might mean you need to reevaluate. He uses Electa, the medical tech company, as an example.
Okay.
Accounting red flags and insider selling pointed to problems that led to a share price decline.
So you have to be vigilant, question your assumptions, and be willing to admit you're wrong.
And have a process for reviewing investments and spotting problems early. You need to constantly monitor your portfolio and make sure things are on track.
Don't just buy and forget. Stay engaged.
Right. Finally, Cunningham discusses valuation and market pricing for quality companies.
That's the tricky part, figuring out what a company's worth and if the market price is fair.
Exactly. He acknowledges that quality often trades at a premium, reflecting their earnings potential and advantages.
So you often pay for quality.
Right. But he argues those premiums are often justified by long-term performance. Focusing only on valuation can make you miss opportunities.
Look at the big picture, not just the price tag.
Exactly. Take a holistic view, considering not just current multiples, but also growth prospects, the strength of their advantage, and their ability to generate cash flow over time.
Understand the quality of the business, not just the number.
Right. And he emphasizes having a margin of safety when investing.
A key concept in value investing.
Exactly. Buy companies at a price that provides a cushion against potential downsides. It's like a buffer in case things don't go as planned.
A safety net for your portfolio.
Exactly. He concludes by advocating for a comprehensive approach, emphasizing quantitative and qualitative analysis. He encourages a framework for mistake reduction, involving thorough research, a long-term perspective, and learning from mistakes. He stresses patience, discipline, and a focus on the long term.
So be thoughtful and deliberate in your approach. It's not about getting rich quick, it's about building wealth steadily.
Absolutely. So our deep dive into quality investing shows that it's multifaceted. It takes knowledge and judgment. Not a quick fix, but it can be powerful for long-term wealth.
A philosophy, a way of thinking about investing that leads to better decisions and outcomes.
Now, beyond the book, let's touch on some other valuable ideas. One is understanding growth versus value investing.
Terms we hear all the time, but what do they mean practically?
Growth investors usually focus on companies expected to grow earnings at an above-average rate. They often pay a premium, betting on future potential.
Those high-flying companies with room to grow.
Exactly. Value investors look for companies they think are undervalued. They focus on things like price-to-earnings ratios, price-to-book ratios, and dividend yields. They're looking for companies trading below their intrinsic worth.
The hidden gems that the market has missed.
Right. Though presented as separate strategies, many successful investors blend both. Growth and value aren't mutually exclusive, and the best investments often have characteristics of both.
It's about finding that sweet spot, growing and undervalued.
Absolutely. Another thing is understanding risk.
You can't talk investing without risk. It's part of the game.
All investments have some level of risk. You need to understand and manage it.
So how do we do that effectively?
Diversification. Spread your investments across different assets, industries, and regions.
Don't put all your eggs in one basket.
Right. Reduce the impact of any single investment on your total return.
So if one goes bad, it doesn't sink the whole ship.
Exactly. Another tool is position sizing. How much of your portfolio you allocate to each investment.
How much you bet on each horse.
Right. By carefully sizing positions, you limit potential losses, even if something performs poorly. Don't get overexposed to any single company, no matter how much you believe in it.
Balance conviction with caution.
Now, about performance. Have realistic expectations.
It's easy to think you'll get rich quick, but it rarely happens.
Right. It's tempting to chase high returns, but investing is a long game. There will be ups and downs. Be ready for the bumps and don't panic.
Stay focused on the long term.
And remember, past performance doesn't guarantee future results. Just because something did well before doesn't mean it will continue.
Past performance is no guarantee of future success. We hear it all the time, but it's important.
So, to wrap up, here are some key takeaways from our deep dive into quality investing.
Let's recap. What are the main points?
First, quality companies have durable competitive advantages, strong financials, and a proven track record of generating value for shareholders.
Companies built to last.
Second, identify them by thoroughly understanding their business model, industry dynamics, and management team.
Do your homework. Know the companies you're investing in.
Third, be aware of potential pitfalls. Cyclicality, technological disruption, shifting customer preferences.
Understand the risks. Be ready for the unexpected.
Fourth, quality investing takes patience, discipline, and a long-term perspective.
Stay focused on your goals and don't get caught up in the short-term noise.
And finally, have a process for evaluating, managing risk, and learning from mistakes.
Have a plan. Stick to it.
Investing is a journey. It's about constantly learning, adapting, and making informed decisions.
It's a lifelong process.
And by focusing on quality, you increase your chances of reaching your financial goals.
Couldn't agree more. One thing that stuck with me from Cunningham's book is that quality investing isn't just about finding great companies. It's about avoiding big mistakes.
Absolutely. He talks about mistake reduction,
Uh,
research, long-term orientation, learning from past missteps.
Like a mental checklist to spot red flags and avoid businesses that destroy value instead of creating it.
Exactly. He highlights warning signs, profit warnings, accounting irregularities, declining returns on capital.
Be skeptical. Question assumptions. Dig deeper when things seem too good to be true.
He uses Electa, the medical tech company, to show how seemingly strong growth can hide problems.
Right, their issues and insider selling ultimately pointed to deeper problems that led to a price drop.
It shows that even when numbers look good, there could be hidden problems.
Do your due diligence. Understand the whole picture.
Cunningham emphasizes patience and discipline when putting a quality investing strategy into action.
It's tempting to time the market or chase hot stocks, but he argues that those rarely work long-term.
He advocates buy and hold. Find companies you believe in and hold them for the long term.
Trust your research, your judgment, and have the conviction to stick with your investments.
And have a margin of safety.
That resonated with me. Buying at a price that cushions against potential downsides.
Exactly. A buffer if things don't go as planned.
A safety net for your portfolio?
Right. You might be thinking, okay, but how do I find these companies?
Yeah, how do you find them?
There's no magic formula, but look for companies with strong competitive advantages.
Those factors that allow them to outperform rivals and generate those superior returns over time.
Cunningham points out several types: brand strength, economies of scale, network effects, proprietary technology.
Find companies with a real edge, something that sets them apart.
He encourages you to think critically about the durability of their advantage. Can competitors easily replicate it?
It's not just about having an advantage today, it's about one that can last.
Exactly. Second, look for companies with strong financials.
Healthy margins, strong cash flow, low debt.
Signs that a company's run well, generating profits, and not overly reliant on borrowing.
Make sure the engine is running smoothly.
Finally, pay attention to the management team.
Experience, alignment with shareholders, a good track record.
All crucial questions when you're evaluating long-term potential.
Find companies led by people you trust and believe in.
Remember, quality investing is about finding companies built to last, that can generate sustainable profits and compound your wealth over time.
Companies that can weather the storms and come out stronger.
Focus on fundamentals, be patient and disciplined, and avoid those big mistakes. You can increase your chances of success.
So we've explored the key elements of a quality company, those recurring patterns that signal strength, and how to identify pitfalls.
As you look at companies, keep asking those key questions. What are their advantages? How resilient are they? And are they adapting to the changing world? Quality investing is a process of discovery and critical thinking.
It's not about getting rich quick. It's about building a portfolio of solid companies for consistent long-term returns.
And with patience and discipline, you can achieve your financial goals.
Thanks for joining us on this deep dive into quality investing. We hope you found it insightful, and we'll see you next time.